Yay, it worked. It worked. Hi, everybody. Happy February 26th. We got a great crowd coming in. Wonderful. I'm going to give it a minute or two to make sure everybody signed up can get in before we start. It seems that this is a very popular topic. Super. I am going to get started. So thank you for joining us. When people think about retirement, they usually focus on markets, returns, volatility, whether they're invested the right way. But after working with pre-retirees and retirees over the past 21 years, what actually determines whether money lasts isn't usually the markets, it's taxes and cash flow. Specifically, when income is taken from which account, there are different kinds of accounts, and how those decisions stack over time. Today, we're going to talk about, well, here's the thing. We're not going to talk about tax law or reacting to headlines. It's more about retirement tax strategies and really income decisions and shaping income and giving you flexibility and just power over deciding when to take investments out of your savings. This is going to work. Okay. So before we introduce ourselves, I want to just set our expectations on what this conversation is. This is not a tax update, although if you are interested in one, we can do that. It's not a checklist of things you need to do tomorrow. It's really defining what your plan is. This is a planning conversation, and it is focused on how tax decisions are made and how they affect retirement income, giving you flexibility and helping you make your money last as long as possible. You will not need to memorize this stuff. This is a recorded session, so you will get a replay. The goal is to help you think more clearly about decisions, which decisions matter and which ones don't. So for those of you who may know me, I am Kelly Olchek. I'm the managing partner of Lindley and Company. We are a 100% owned registered investment advisor. We're here in the Bushnells Basin outside of Rochester, New York, and we work with a handful of families and help them with their financial planning, investment decisions, and retirement savings. As fiduciaries, our responsibility is simple. We put you guys first. I mean, it's more important for you guys to know that we are looking out for your best interest. I have been a certified financial planner since 2009, and the thing I love the most is helping people take their financial complexity and make it more clear and helping them become more confident. Joining us today is Chaz Miller. She's our operations manager. She's going to be our Vanna White. She's going to help with monitoring the chat. So please feel free to raise your hand and ask questions. I do this for a living, so sometimes I forget that you guys don't know what I do. So she's going to be monitoring the chat. So feel free to chime in. Additionally, my partner, Becky Gillette, who is our Chief Compliance Officer, is joining us. She's got a brand new brand baby, which is why she's on mute. Very few firms our size have a dedicated Chief Compliance Officer. So when Becca and I started this practice, we felt it was very, very important for her to really focus on operations and compliance. So with that, let's get going. So last year, the Tax Cuts and Job Act that was pushed out in 2017 did not sunset. So a lot of the topics we're going to talk about today are focused on those changes being, many of them being permanent. So one of the biggest shifts in retirement isn't the markets, as I mentioned, it's income, where you're going to get your money for. And while working, you're paying taxes, and that's pretty straightforward. You earn a paycheck, you withhold taxes, and the rest shows up in your checking account. But in retirement, you decide when income shows up, and sometimes the IRS decides for you. The third shift that most people underestimate in retirement is tax decisions don't just affect this year, but they compound over time. With a withdrawal today changes next year's tax bracket. It can change Medicare premiums. It can affect how your future RMDs stack up, and RMDs are called required minimum distribution. I'll dig into that detail in a second. And once that income is recognized, you don't get to rewind it. And that's why tax strategy and your retirement planning matters so much. So again, I want to make this really clear. Paying taxes isn't the problem. It's controlling when you take those taxes. And many people are surprised to find out, well, they've been really, really good savers. And when they are being asked to or being made to take their required minimum distribution out, they are very surprised by the tax brackets that they could show up in. And that creates a lack of flexibility. So once those decisions are made, there's no way to undo them. So we're going to try and give you some ideas on how to take control of this. Layered on top of that tax environment that changed significantly over the past few years. So some rules have settled, giving you more clarity than you had before. For those of you over 65 this year, and actually last year, even if you are not taking your Social Security, you're going to have a $6,000 deduction, which is kind of nice. So we're talking about the longer term strategies, and timing matters very much. So here's where a lot of people get tripped up. When rules change, it's easy to feel like you've got to do something, and not every change means you need to do something. It's just understanding how it could affect you. A good retirement strategy really does look into incorporating a tax strategy. It's about understanding which decisions apply to you and making them in the right order. Some strategies are really powerful, and handled in the right context, they can have a really huge impact on your situation. So we're going to have 3 polling questions. We're not going to kill you with those. So Chaz is going to launch that. And if you guys could take a minute and help us out, we want to make sure that we are on track with our conversation.
Thank you, everybody. I will end that now and share.
Thank you, guys. Yeah, taxes are a big thing, and income timing. Like, now you've done all the saving, now what? Where do you start? It's the most efficient way to do that. So, how do you know what matters for you? And I'm going to help you find a filter that might help you start defining what's most important to you. Retirement tax strategy usually shows up in a few specific places, like how income is timed and the types of accounts that you are taking income from. So you've got a checking and a savings account. You've got maybe a brokerage account. Those dollars have been taxed already in a manner of speaking. You've got maybe some Roth accounts. You've got, and so those dollars have already been taxed. You've got IRAs, 401ks, 403bs, and the majority of that probably has never been taxed. And how the future stacks up for that required minimum distribution matters. So RMDs, and that's the amount that the IRS requires you to withdraw each year from your pre-tax retirement accounts. Those are your 401ks, your IRAs. And the IRS makes you do it at a certain age. For some people right now, it's 73. For others, it's 75, depending on when you were born. For my mom and dad, it was 70. So it has pushed back. And that window, being able to push it back from where it was 70 to 73 or 75, that is the really cool thing, the really cool window that allows us to make changes on how we are managing our money, really. It also will affect Medicare and your premiums for Medicare, and also legacy considerations. The challenge isn't understanding every rule, it's knowing which of these areas deserve attention and which ones don't right now. Okay, so before we talk about specific, my brother used to say specific strategies, I want to slow down. At the end of this session, you're gonna have a couple handouts that are gonna help guide you through filters that are particular to you. These are meant to help you step back and decide where your attention actually belongs. Because, like I said, not every tax change or planning idea applies to every person. One of the biggest mistakes people make is jumping into a strategy before they understand whether it's relevant to them. So this handout is something that I use as a reset every year. It starts with your life because life changes. And so planning should also. Everyone's ride is different. So with this handout, it'll help you start thinking about your own personal situation. It'll talk about cash flow because if income feels tight or unpredictable, nothing else should come first. We got to figure out where your income's coming from. Only after that do we look at how your assets are structured. So I took screenshots of this handout. So you're going to have a solid document with all these boxes in there. And then it talks a little bit about how taxes show up over time and whether there are any legal or legacy issues that need attention. The reason I like this tool is that it doesn't tell you what to do. It just helps you decide where to focus on. Okay. Any questions at all? As y'all know to talk. Okay. Up to this point, we've talked about these filters, how to decide what deserves attention. What I want to know now show you is, what this looks like in real life, because I think storytelling makes this boring stuff maybe more interesting for you. So I'm going to share with you how we helped another family. Because some people get so overwhelmed they don't know where to start. So I think that's why we're going to walk through this illustration. One more poll, if you wouldn't mind taking a second there so we can kind of see where each of you are sitting on this spectrum. I am so grateful for your participation in this. It's super helpful.
I am sharing that now, Kyle.
It's great. Well, this poll tells me I'm hitting the mark. So thanks, guys. That's super helpful. All right, let's dig in here. Planning only becomes useful when it takes that insight and that reflection that you have done and help you make decisions. What we're moving into now isn't theory or checklist. It's this real life decision making and what it looks like. One of the biggest mistakes I see people make is starting with strategy before they even understand whether it fits. And so Roth conversions, everybody's talking about Roth conversions, and Roth conversions is a really neat thing because of the later date and required minimum distribution. But just because you do a Roth conversion doesn't mean you solve the problem. So walking through this example should kind of help you understand what it might look like for you. So this isn't about copying a strategy. It's more about how does this strategy, how it could affect you. And it just because a topic is trendy, it doesn't mean you need to do it. So it's not because it's trendy, it's not because it's urgent, it's because it makes sense for you in your big picture. My hope is that this helps you recognize when something belongs in your plan and or maybe when it's not time yet. Okay, this is the last poll of the session. Cool. Chaz, can you unmute Kathy?
You?
Yep, thank you. And also, could you unmute Kathy Lee? I want her to answer my question because she said better than the IRA, and I don't know if that's a question or a statement.
I think it's just a statement.
Okay. This is actually a good point. So the difference between a traditional IRA and a Roth is that the dollars in a traditional IRA or a 401k or 403b, majority of those dollars have never been taxed before. Thank you, Kathy. So when you take your income out of your IRA, all of those dollars have been taxed. None of those dollars have been taxed. If you have a Roth IRA, the dollars that are in the Roth IRA have been taxed and they grow tax deferred just like a normal IRA. It's just when the dollars come out of the Roth, none of it's taxed. The growth and the original amount that comes out is not taxed. And I'm very happy you asked that question because it just dawned on me. I didn't explain that. So thank you. Any other questions? Keep it coming. Okay. So looking at, again, you guys are making me look like a rock star. I'm hitting the topic. Thought you said it when we moved money once. Yep, we did. We're going to do it more than once, because this is a multi-year strategy that actually we're going to move into an explanation now. Okay, so let's talk about, these are real life clients, but I changed their names. So we're going to talk about Bob and Kathy. Bob recently retired at 64. Like many people we work with, they're what I'd like to call really good savers. So they are looking at the curse of the good saver. So they did the hard part well. They did the saving consistently over decades. What really mattered for planning wasn't timing. They had a long runway. So, he's 65. And he is going to have to take money out when he's 75. So we have like this 9-year window where we can pay taxes across this period of time. So he doesn't get really hammered after he's 75. And just as important, they had a very, very clear picture of what their expenses were. So they knew what kind of income they had, Social Security, pension. They also knew what expenses their must-haves are. And for those of you that work with me, I know that I've built an uh-oh bucket for rainy day money and also a vacation bucket, a fun money bucket. Okay. So that clarity allowed us to move forward with this strategy. All right. So this is all for Becky. I am not giving you tax advice. I want to be very clear. I'm going to show you some really cool things. And at the end of the day, before we implemented anything, we worked with this family's tax preparer. Once we identified the scenario that worked best for them, that's when we approached the tax preparer and they help us because I don't do taxes. So I don't know everything about that. But with their help, with the tax preparer's help, we were able to carve out the right amount. So what I'm showing you is not the final number. It was the idea. And then we walked toward the tax preparer. Okay. And that collaboration is super important to implement the strategy. Okay. With Kathy and Bob, before Roth conversions were even on the table, there was groundwork that we had to do. First, we had to identify exactly where their retirement income would come from, whether it was guaranteed, maybe they have an annuity, maybe they have a pension. We need to know their Social Security income, okay? We also set aside cash and brokerage assets intentionally so that we could pull so we weren't forced to pull money out of their retirement accounts early if they didn't want to do a Roth. Then we mapped where their money actually lived. What was in brokerage accounts? What was in banking accounts? What was in IRAs, 401ks, 403bs? And if they had a Roth, where was that? And the key here was it wasn't a sense of urgency. It was really just laying that groundwork without pressure. And that's really what created an opportunity for this planning. Okay, so for those of you who work with us, you know we have really cool tools. And this is an illustration that will share what their taxes might be without a Roth conversion. We're going to see this slide more than once. But once that foundation was in place, the question then wasn't about generating income because we'd already solved that. What really surfaced instead was very different taxes. Not this year, but over the rest of their lifetime. I firmly believe that my job for our clients is to mitigate risk and help them pay the lowest amount of taxes over a lifetime. And so this slide illustrates what the implications for taxes would be without a Roth conversion. And going back to that, the curse of the good saver, because they were great savers, they were very surprised to see what kind of taxes they were going to be made to pay without planning. But with a long-term runway before that RMD was needed to come out and no immediate income needs because their other money covered their everyday money, the Roth conversion just made sense. Okay, so once the planning question was clear, the next step was not to find the best answer, but understand the trade-offs, right? So I know a lot of people hate to pay taxes, and some of this strategy did increase this client's Medicare premiums, but modeling is what we really worked on, and that's what I'm going to show you now. So we started with that baseline. This is what happened if Bob and Kathy do nothing differently. There's nothing wrong with this plan. Their income is steady. The spending is covered. The portfolio worked great. This simply gives us a preference point of where we can start picking away and saying, what ifs, okay? So the next thing we did was deliberately model a Roth conversion strategy. Again, not all at once, not aggressive. And we were able to move the levers to see what worked, what fit. And again, it wasn't about maximizing conversion because in the end, we did not model all of the IRA money coming out. We controlled it. So again, it's all about control. Okay, for each scenario, we looked at taxes year by year. The goal again wasn't maximizing or minimizing taxes in any one year, but to understand how they stack up over time. We also looked at how these decisions affected future required minimum distributions and what could ultimately pass to their children. And while this multi-Roth strategy, focused on reducing lifetime taxes, it actually had a benefit to their two children. And some of you have inherited money from your parents, and I have not seen one person inherit a Roth, believe it or not. But if your children inherit a Roth, all the money in that Roth is tax-free to them instead of this big whopper of an IRA. And they have to take up for both a traditional IRA and a Roth. They have 10 years where they have to get that money out of either a Roth or an IRA. So it ended up having an extra secondary awesome bonus. When we looked at the modeling side by side, something became very clear. Again, it wasn't about market volatility. It was really about how do we build a multi-year strategy. So this is a redundant slide. You've seen it. So this is the total taxes paid, and the amount of taxes were over $1.3 million. And we looked at brackets. So you'll see at the very beginning from like this year until 2035, they're under the 22% tax bracket. But when they have to start taking required minimum distributions, they bump themselves up in the 24, even the 32% tax bracket. So if we modeled paying taxes between now and when Bob turns 75, we kept him in the 22% tax bracket, and it reduced his taxes over a lifetime by over $653,000. Just think about that. Yeah, I didn't want to pay a lot of taxes at the beginning, but by doing that, I saved a ton of money. So this is what their tax bracket looked like during that period of time. So they were over the 24% tax bracket. They have always been in the 24% tax bracket. But afterwards, they're in the 10% tax bracket. And then we understood why that secondary outcome was awesome, because when and if it's time for them to pass their assets along to their children, the majority of those assets are tax-free. I want to pause here and be very clear about why this worked. It worked because we had a great foundation. These clients knew what their expenses were. These clients knew where their income was coming from, so they didn't have a ton of income pressure. The decisions, what will happen moving forward, while we have this model, believe it or not, I can't see the future. So it's something that we monitor every year, and we collaborate with their tax preparer every year, because it's definitely not a set it and forget it thing. Okay, it is a strategic process that some years you'll do it, maybe some years you don't. So this is not saying that Roth conversion everybody should be doing a Roth conversion. That's not what I'm saying. It's a strategy. The real takeaway is good decisions come after you understand where you are, what's changed. So right now the tax code has changed. I've got some clients that that have retired early and they still need income, but their tax bracket is very different. Where they were in the 24% tax bracket, now they're in the 12% tax bracket. So that's a huge opportunity. And time, they're young. Um, if something we talked about today, taxes, income timing, long-term flexibility felt unclear, it's a signal. I would love to sit down with you guys and share this with you and model what it looks like for you. Some of this won't work for everyone. Some of it will. Some of this might not be ready yet, if you know what I mean. At the end of the session, you're going to get 3 handouts, okay? One is that checklist we reviewed earlier. Another one is called important numbers, and those are updates on like your standard deduction has changed, what those kind of numbers are for 2026. And then there's a flow chart, the Roth conversion piece is a flow chart that helps you say, is this right for me? Yes or no. So that is a lot of information, but that is it, folks. And I know that this is a lot of information. I would be very happy to sit down and talk to anybody that wants to walk through this with me. And I'd love to hear any questions that you guys might have before we sign off. Crickets, no worries. So this is the important slide that Becky always makes me show. Like I said earlier, I am going to post this replay on YouTube, and you're going to get the replay and the handouts. If you have somebody you care for and think they might benefit from this, please share it with them. We just feel that this is a really great opportunity for people to take more control over their investments. Regine, do you have a question? Chaz, can you unmute her? There she is. Oh, there you go. Hey, Regine.
Hi. My question is regarding emergency funds compared to as far as where does that fall between IRA, RMD, but also Roth multi-year. Do we continue to put money into an emergency fund, or we do just put money and it's parked? Can you talk a little bit about that?
Yes. So thank you for that question. So I have this saying, there are 3 kinds of money: now money, later money, and never money. So now money is an account. I like to see 3 to 6 months of emergency money in boring old cash. The water heater went and now I need to replace it. Later money is what we're talking about: Roth IRAs, brokerage accounts, long-term investing accounts, IRAs. Those later accounts, some of you need those later accounts now, but they are invested more long-term. And then never accounts are the legacies for the kids, or ASPCA. Does that help, Regine? And one more thing I'll say is, I have a client who is about to retire probably this summer, and I manage his 401k at Xerox, and he just said, I really like what you're doing, but I also know that if I'm going to leave work, he's in this age bracket where if you take money out of your IRA, so he's over 55. So between the age of 55 and 59 and a half, if you have money left in a 401k and you leave work and you need income, distribution from that 401k, there's no penalty. You're still going to pay taxes. But so his worry was, I really want to put a chunk of money out of the investments and into something more stable. And so even in the 401k, we carved out, now it's a $2 million 401k, okay? We carved out 20% of that and put it in the money market option in his retirement savings. Because if he leaves work, we know that if he needs income, that set aside is there, even though the market's done really well. He just wanted that earmarked. So the emergency cash can be earmarked in any kind of account, but I think of it as a checking account, a savings account, or a money market, because you don't know when you're going to need it, but you might need it soon, sort of thing. Any other questions? I'm really grateful for all of your participation. I see that some folks showed up a little later, and I did mention that we're gonna have this recording sent out to you once it uploads to YouTube. And any questions you have, I'm all ears. Yeah, so thanks everybody. I'm really, really happy that you guys were able to join us.
Oh, that was cute. Thanks for the floating little thumbs up,
Yeah,
whoever
where did
that was.
that come from? Who did that? That was adorable. Thank you.
Have a great rest of your day, everybody.
Bye-bye.